So we've got some economic numbers that we wanted to bring you this morning, starting with the housing market. And let me give you a little bit of context here before I put the first article up on the screen. I mean, obviously, we all know how expensive homes are, both in terms of the sticker price and in terms, critically, of the mortgage interest rate that you have to pay. And of course, the higher the mortgage rate is, the more important it is to have a big down payment. So you're paying down some of the principal so that you're getting hit with less of that mortgage interest rate. So it's less critical, even though it still makes this huge difference. Well, in this landscape, if you are a young person trying to buy a house, good luck. And one of the only ways they're able to pull this off, and put this up on the screen because we've got new numbers now to back this up, for under 30 homeowners, 4 in 10, so 40%, rely on family money to cover their down payment on that property. So basically, if you're under 30 and you want to get a house, you got to have mommy and daddy with cash in the bank ready to pony up your down payment, or you can forget about it. Now, this obviously has huge implications for generational wealth, has huge implications for just like the story we tell ourselves in this country about the American dream, about how anyone can aspire to this level of middle-class prosperity and with the house and the white picket fence and the family, et cetera. I mean, the new story of our economy is if mommy and daddy aren't underwriting it, you can forget about it.
Mm-hmm. What really came through from this with the amount of people who are doing this is we talked previously about the wealth transfer and how a great wealth transfer that's happening right now is really from from boomers who are either aging off and are dying or are already preemptively transferring or helping out their elder millennials have entrance to the homeowner market or asset ownership. And because asset ownership at an earlier point and allowing it to appreciate the course of your life is the single best way in order to attain wealth in this country, the ability then in order to access that tap of wealth is so important. And if the only ability is to have well-off parents, well, you're in a real tough situation if you don't even have that. And you know, the problem is I was even reading more recently about how high interest rates have made it so that people are disproportionately finding it harder in order to get a mortgage. The reason why is that the bank can earn off of straight up deposits 5 or 6% or whatever from the Federal Reserve or from T-bills. So you better be a pretty damn good lender or a damn good borrower if you are actually going to be an attractive asset for them. In that way, then, it's even harder today to actually qualify. Specifically, I was reading for a jumbo mortgage because the competition for your business has just gone way down in the era of a high interest rate environment. On the one hand, that could be a good thing. It means that, you know, people aren't getting access to loans or whatever that they can't pay. But it's really difficult if you're a younger person. And you have to prove your ability in order to pay in the future. Or if they knock you down in the price of house, and the only way that you're even able to come to the price where you're living in an urban market or whatever is to have the signature of a parent. What if your parent didn't do that well? What if you're self-made? What if you're a first-generation college graduate? Or any of those? It puts you at a very, very significant disadvantage.
For your whole
for your whole life.
And it really creates these hard class lines that it's like whatever station you were born into, that's what station you are likely to remain, regardless of how you know, how well you do in school and you play by the rules and you do all the things that you're supposed to do. If you don't have mommy and daddy able to stroke you a check for your down payment, it will be very hard for you ever to get on that home ownership ladder, especially if you live in one of these, you know, very expensive metro housing markets. Just to give you a little bit more of the data here, this was from a survey by Redfin, and they found that 23% of homeowners under 30 used a cash gift from family members to cover their down payment. Another 21% used inheritance money. So that's where you add those numbers together, you get 44% who are using either, you know, money from family member or some sort of inheritance to be able to achieve home ownership. And so, you know, it really does kind of cut to the core of what we think about how this country should work and the upward mobility that should be available to people. They've coined this term Nepo homebuyers to refer to young people who are relying on family money in order to get on this property ladder. But increasingly, this is the only way that young people are able to achieve those milestones. And at the same time, There's other numbers that are coming out about how difficult the economic landscape is for a lot of people, in spite of some of the headline numbers that look pretty good of low unemployment rate and all of these things. But if you dig into those numbers even an inch, you see how much pain there is out there in the economy. Let's go ahead and put this up on the screen. This is, in some ways, one of the most critical indicators of how people are actually doing. This from the Washington Post. They say delinquencies rise for credit cards and auto loans, and it could get worse. With interest rates going up, more consumers have missed payments on household debt. Put this next graph up on the screen because you can see really clearly what's going on here. Over the past 2 years, really, you've seen the number of delinquencies for all types of debt, whether it's consumer loans, credit cards, or auto loans. You see those numbers significantly spiking and heading in an upward direction. This tracks very closely, of course, with the end of the pandemic era programs that helped people get through the pandemic, that provided people with a little bit of cash in their bank accounts. And it coincides with a Federal Reserve policy of hiking interest rates that, of course, makes all of that debt so much more expensive and so much more difficult to pay off. Let me just read you a little bit of this article and then we'll get Saagar's reaction. They say more Americans are falling behind on their car loan and credit card payments than at any time in more than a decade. Troubling signal of consumer stress as higher prices and rising borrowing costs are squeezing household budgets. The pain, of course, they say, is most acute for lower income earners who have largely used whatever they managed to save during the pandemic with the help of government stimulus checks and breaks on obligations such as rent and student loans. They've got a quote here from Mark Zandi, who's chief economist at Moody's Analytics. The increase in delinquencies and defaults is symptomatic of the tough decisions these households are having to make right now, whether pay their credit card bills, their rent, or buy groceries. So when you have inflation that has cooled some, but still has goods, especially like critical things that people have to buy, much higher prices than they were prior to the pandemic. You have the end of pandemic era programs, and you have interest rates going up, making all of this debt so much more expensive, you end up with a really dire landscape such as this.
Yeah, and you're looking at it, and it's just clear that we're going right back to the days of the post-Great Recession, which was some of the worst days in modern U.S. economic history. I don't think you can really write it off. It was so horrible. It was one of those where we didn't realize how bad it was at the time because we had just gone through the Great Recession. But that is really when people got completely wiped out, and it really is reminiscent of the Great Depression. The worst of the Great Depression was not 1929. It was 5 years in, because at that point, you have the compounding poverty, you have the compounding inability to get housing, compounding inability in order to catch up, and that's when stuff really just starts to break. And that's when a lot of people just gave up. They either exited the workforce, became permanent renters. That's also with zero interest rates whenever the billionaire class and the corporations really got richer than ever and started especially accelerating financialization. So this is a really bad place to be, to have consumer debt and all of that basically return to 2012 levels, except at that point, there was at least some zero interest rate stuff going on that was juicing the broader economy. Now we don't have either of that. We even have a reduction in overall earnings, and our growth is generally anemic. So, I mean, this just looks, everything just feels very 1970s right now.
I was sort of shocked by the average credit card interest rate that they have in here.
What is it?
It's 20.6%.
Yeah, that's not surprising.
That's a record high, 20.6%. So it just shows you when you get behind on those credit card bills, or if you're having to rely on credit cards in order just to make ends meet, how quick you can get behind and, you know, basically have no prayer of ever paying that off at 20.6%. I mean, that is really high. And that's just the average. That means a lot of people have rates that are a lot higher than that. They also point to something we covered before, which is that total credit card debt just topped $1 trillion for the first time ever. And I didn't know this statistic. There are 70 million more credit card accounts open now than just back in 2019. I mean, that wasn't that long ago. Americans have opened up 70 million more credit card accounts in that time with these high interest rates. And then the other thing that we're seeing is that, you know, we've had the rise of these buy now, pay later services. If you go on any basically consumer website, they have these options where you can pay for things in installments, et cetera. The importance of those services has also been rising. They say usage surged 40% in the first 2 months of 2023. So it shows you that people are really struggling just to buy things like groceries, other necessities, pay their rent, etc. They're having to lean on debt that has now very high interest rates in order to get that done, and they are really squeezed in spite of, you know, any of the celebratory type top line numbers about unemployment being low, etc.
Yeah, these are the numbers that matter the most. And things were better, you know, a couple of years ago, and now they're getting bad, and they're all on the uptick. So this is the single biggest problem, crisis facing people, the ability to keep up with everyday life. And let me just echo what you said. Please do not go into a crazy amount of credit card like that debt unless you really are in a bad situation. 20% interest, that is, you know, that is horrible, because that's 5 months and you basically doubled. I mean, what are you going to do? And, you know, and especially if you can't make your minimum payments or any of that. So look, you know, I'm not going to tell anybody how to live. I'm just going to beg people, don't find yourself in that situation. I got friends and people in my life I know who are in that situation. It becomes overwhelming and all-encompassing in, you could blink an eye and watch it all just quadruple, triple, or something like that. And then you just feel helpless. You don't know what to do. So try not to put yourself in that situation. But people who are finding themselves in there in order to make general ends meet, I get it. I don't know what else you can do, you know.
Hey guys, if you like that video, go to breakingpoints.com, become a premium subscriber, and help us build the best independent media organization on the planet.
That's right. We're subscriber funded. We're building something new. We want to replace these failing mainstream media organizations.
So again, to subscribe, it's breakingpoints.com.